Today's story is from The Psychology of Money by Morgan Housel. Stay with us, because the lessons you'll hear today can change the way you think about wealth forever. Hi and welcome to Audiosaar. Whether you're seeking success, happiness, or personal growth, you'll find it here. Stay tuned, because every story has the power to change your life. Let's dive in. Chapter 1. No one's crazy. Imagine two people, one grew up during the Great Depression, the other grew up during the tech boom of the 1990s. Their views on money will be completely different. The first might save obsessively, fearing collapse. The second might feel comfortable taking big risks in the stock market. Both behaviors make sense, because financial decisions are shaped by personal experiences. Housel reminds us that no one is truly crazier with money. People just see the world differently, depending on their background and life story. This explains why two smart people can disagree about the same financial decision. Chapter 2. Luck and Risk. Bill Gates became the richest man in the world because he had talent, but also luck. His high school was one of the very few in the world with a computer in the 1960s. That opportunity changed his life. But at the same school, Gates' friend Kent Evans, who was equally brilliant, died in a mountaineering accident before reaching adulthood. Luck lifted Gates, risk took Evans. The lesson: never judge outcomes, only by effort. Success and failure always contain elements of luck and risk. Stay humble, and don't assume wealth is purely earned or lost by personal decisions. Chapter 3. Never enough. Consider Roger Gupta, a successful businessman worth over $100 million. Yet, he engaged in insider trading to try and get even richer. Why? He didn't know what enough was. Housel warns, if you don't define your enough, greed can ruin you. Wealth should be a tool for security and freedom, not endless competition with others. Chapter 4. Confounding compounding. Warren Buffett's net worth is over $100 billion. What's fascinating? $81 billion of that came after his 65th birthday. Buffett is not just a good investor, he's a patient one. He started at 10 years old and never stopped. Compounding works like planting a tree, the biggest growth happens late, after years of quiet progress. But most people give up early. The lesson? Time is the most powerful force in wealth building. Chapter 5. Getting wealthy versus staying wealthy. Becoming rich requires risk, optimism, and taking chances. But staying rich requires survival skills, humility, frugality, and paranoia. Many people who strike gold lose it because they don't protect it. Think of it like climbing a mountain. Going up requires courage, but staying on top requires caution. The biggest key is avoiding ruin. Don't gamble everything, no matter how confident you feel. Chapter 6. Tails, you win. In investing, most success comes from a few big wins. Out of thousands of companies, only a handful, like Apple, Amazon, or Google, drive the bulk of market growth. Venture capitalists know this. 9 out of 10 of their bets fail, but one success pays for everything. Life works the same way. A few events shape the majority of outcomes. Your job is to stay in the game long enough to catch those rare, powerful moments. Chapter 7. Freedom. Imagine waking up and having full control over your day, no boss, no forced commitments. That's true wealth, the ability to do what you want, when you want, with whom you want. Money buys many things, but the highest dividend it pays is freedom. Beyond a certain level, material goods add little happiness. Control over your time is priceless. Chapter 8. Man in the car paradox. You see someone driving a luxury car and think, wow, they must be rich. But in reality, people are admiring the car, not the driver. Ironically, the owner doesn't get the respect they imagine. Housel calls this the man in the car paradox. We think possessions will earn admiration, but people rarely care. True respect comes from behavior, not luxury. Chapter 9. Wealth is what you don't see. A neighbor drives a new BMW. Does that mean they're rich? Not necessarily, it only shows what they spent, not what they saved. Real wealth is hidden, savings, investments, and the security you don't flaunt. This is why many truly wealthy people look ordinary. They quietly build assets instead of chasing appearances. Wealth is invisible, it's in the bank, not in the driveway. Chapter 10. Save money. High incomes don't guarantee wealth. Many people earn millions and end up broke because they spend it all. What matters is your savings rate, not your salary. Saving is the gap between your ego and your income. When you save, you're buying flexibility and peace of mind. Housel calls saving the only financial factor completely within your control. Chapter 11. Reasonable the rational. Economists say the rational investor maximizes returns. But humans are emotional creatures. For example, keeping some cash in a low-interest account may seem irrational, but it provides peace of mind during emergencies. Therefore, reasonable decisions, those you can live with, are better than purely rational ones. Chapter 12. Surprise! The world is constantly changing. No one in 1990 predicted the Internet's rise. Few predicted the 2008 financial crisis or the 2020 pandemic. History feels obvious in hindsight but was uncertain in real time. The lesson: don't assume the future will behave like the past. Expect surprises and build flexibility into your financial life. Chapter 13. Room for error. Because surprises happen, you need a margin of safety. Investors should keep cash reserves. Businesses should prepare for downturns. Individuals should avoid living on the edge. Housel explains, the biggest financial mistakes come from overconfidence and lack of buffers. Always give yourself wiggle room. Chapter 14. You'll change. What you want today may not be what you want in 10 years. Many people build financial plans for a future self that no longer exists. For example, someone who dreams of being a high-powered executive at the 25th of May later value family time more than career prestige. Accept that your goals will evolve. Build flexibility so you don't trap yourself into a life you no longer want. Chapter 15. Nothing's free. Everything has a price, even if it's not visible. High returns come with volatility. Business growth comes with sleepless nights. Fitness comes with discipline. When you see someone enjoying success, ask, what did they pay for it? If you want similar results, be willing to pay the same hidden cost. Chapter 16. You and me. Different people have different financial goals. A young trader might gamble on volatile stocks for fun. A retiree invests conservatively for safety. Both decisions make sense for them. Problems arise when you copy someone whose goals differ from yours. Never take financial advice without considering your own timeline, needs, and comfort. Chapter 17. The seduction of pessimism. Bad news sounds smarter than good news. When someone predicts a crash, it feels urgent. Optimism feels naive. But historically, optimism has paid off. Markets rise over the long term, even after crises. Housel explains, pessimism grabs attention, but optimism builds wealth. Chapter 18. When you'll believe anything. During booms and busts, people believe crazy things. In bubbles, investors convince themselves prices will rise forever. In crashes, they think the system will never recover. This is human psychology at work. Fear and greed distort judgment. The solution? Step back, stay calm, and remember that extremes don't last forever. Chapter 19. All together now. At this point, Housel brings all the lessons together. Wealth is built by patience, humility, saving, avoiding unnecessary risks, and focusing on freedom, not appearances. Behavior beats intelligence. Chapter 20. Confessions. In the final chapter, Housel shares his own philosophy. He keeps most of his wealth in conservative investments, even though he knows he could earn more with riskier bets. Why? Because it helps him sleep at night. This reinforces the book's central message: the best financial plan is the one you can stick with. Glowing star final takeaways. Money success is more about behavior than intelligence. Compounding plus patience equals extraordinary wealth. Savings of income. Define your enough. Freedom, not luxury, is the ultimate goal. Prepare for uncertainty, always have room for error. Wealth is hidden, what you don't spend. Optimism wins long term, even if pessimism sounds smarter. The best financial plan is the one that fits you. Sparkles. That's the full summary of all 20 lessons in the psychology of money.
Remember, wisdom grows when you make it a daily habit. So listen to one book a day, and make it part of your journey. Thank you for listening to this story on Audiosaar. If you found value in it, don't forget to like the video, share it with others, and subscribe to the channel for more audiobook-style summaries and timeless wisdom. This is Audiosaar, where stories speak to your soul.